In 1959, Harry Markowitz saw a problem inside his own beautiful theory. Variance treated upside surprise and downside loss as the same thing. Investors did not. A pension fund did not fear a surprise gain. It feared missing the check it had promised to pay. That split between total volatility and bad volatility later gave investors the Sortino ratio, a ruler built around the target they could not miss. Here is the problem in one line. The Sharpe ratio punishes wiggle. The Sortino ratio punishes shortfall. That sounds small. It is not. It changes what we mean by risk. Sharpe gave investors a clean score. Take the return above a safe rate. Divide it by standard deviation. Now every fund has one number. Higher is better. Simple. But standard deviation has a strange habit. It treats a jump upward as risk. It treats a drop downward as risk. Both are surprises. Both enter the same denominator. That is clean math. It is not clean human life. A retiree does not call a surprise gain a disaster. A foundation does not panic because the portfolio beat its spending need. A pension plan does not lose sleep over an extra good year. The thing they fear is shortfall. They fear falling below the line they had to clear. That line is the heart of Sortino. It is called MAR. MAR means minimum acceptable return. It can be zero, it can be cash, it can be inflation plus spending. It can be a benchmark. It is the target the investor names before the score is calculated. The Sortino ratio asks a sharper question than Sharpe. It does not ask, how much did returns move? It asks, how much did returns miss the target? Now picture two funds. Both average 8% a year. The investor's minimum acceptable return is 3%. So both funds beat the target by 5 percentage points. Fund A is lively, it has big upside months, it jumps around. But when it falls below the target, the misses are small. Fund B looks smoother most of the time. But when it misses the target, it misses hard. Sharpe may blur this difference. It may look at Fund A's upside jumps and call them risk. Sortino refuses. It says, do not punish the good surprise, count the bad surprise. That is the whole lesson. Risk is not just movement. Risk is movement in the wrong direction. The formula is Sortino equals R sub P minus MAR divided by downside deviation. Here, Sortino is excess return per unit of downside risk. R sub P is the mean portfolio return. MAR is the minimum acceptable return. Downside deviation is the square root of the average squared shortfall below MAR. Say it in plain English. How much did you earn above your target, divided by how badly you missed that target along the way? Now slow down on the denominator. This is where the ratio earns its keep. Suppose a monthly return is above the target. Sortino gives that month a 0 in the bad risk bucket. It does not matter whether the return was a little above the target or far above it. Above the line is not the problem. Suppose a return falls below the target. Now the shortfall counts. If the target was 3% and the fund earned 1%, the shortfall is 2 percentage points. That shortfall is squared. All shortfalls are averaged. Then we take the square root. That gives downside deviation. It is the bad side cousin of standard deviation. There is one more detail. The shortfalls are squared before they are averaged. That means a large miss hurts more than several tiny misses. A 1% miss is not pleasant. A 10% miss is not 10 times as bad in the math. It is 100 times as large before the square root brings the unit back. This is useful. Large losses are exactly what investors remember. They change behavior. They force sales. They break spending plans. They make a portfolio fail when the average still looks fine. So Sortino has a moral view of volatility. It says the left side of the distribution matters more than the right side. The right side can be noisy. The left side can be fatal. Now run the two-fund example. Both funds earn 8%. The target is 3%. So both have 5 percentage points of return above target. Fund A has downside deviation of 2%. Its Sortino ratio is 5 divided by 2. That equals 2.5. Fund B has downside deviation of 5%. Its Sortino ratio is 5 divided by 5. That equals 1.0. The average return was the same. The goal was the same. The pain was not. Sortino makes that pain visible. Now make the example concrete. Fund A has 4 years of returns. It earns 12%. It earns 10%. It earns 7%. Then it earns 3%. Against a 3% target, it never falls below the line. Its downside deviation is 0. That looks perfect. But be careful. 0 downside deviation does not mean 0 risk. It means this sample did not show a miss. The next year can still hurt. Fund B also has 4 years. It earns 20%. It earns 12%. It earns 9%. Then it loses 9%. The average can still look strong, but the shortfall in the bad year is large. Sortino sees that. This is why the ratio is not just a formula. It is a question about time. Did the history include the kind of year that actually scares the investor? If not, the denominator is quiet. Quiet is not the same as safe. This is why allocators like the ratio for certain strategies. Option income funds can show many small gains and rare large losses. Hedge funds can have skewed returns. Retirement income portfolios can look fine on average, then fail when withdrawals hit a bad market. In each case, upside volatility is not the main question. The main question is whether the strategy falls below the line that matters. But now comes the wall. Sortino is better for some questions. It is not magic. The first wall is sample size. If you only count returns below the target, you may have very few observations. A fund with a short history can look clean. A strategy with only a handful of reported losses can look almost perfect. That does not mean risk is gone. It may mean risk has not shown up yet. CFA Institute's review makes this point with Japan in the 1980s. From 1980 through 1989, Japanese equity annual returns were all positive. Then 1990 brought a 39% plunge. A decade of pleasant annual returns did not prove the downside was absent. It proved the sample had not yet seen the event. That is the trap. Sortino looks backward. The investor lives forward. The second wall is the target itself. Change the MAR, and you change the ratio. A fund can look strong against 0. The same fund can look weak against inflation plus spending. A manager can look different because the evaluator changed the line. That target choice is not a technical footnote. It is the whole contract. If a pension fund needs 7%, 0 is the wrong target. If a cash alternative only promises capital preservation, 0 may be fair. If an endowment must spend 5% and keep up with inflation, a 5% nominal target may still be too low. The formula will not protect you from a lazy target. It will only enforce the target you feed it. So never compare Sortino ratios unless the target is the same. If one report uses cash and another uses a 5% hurdle, the numbers are not speaking the same language. The third wall is stale pricing. Illiquid assets do not always mark to market cleanly. Private credit, real estate, venture marks, and some hedge fund books can report smooth returns. Smooth returns lower volatility. They can also lower downside deviation. That can make the Sortino ratio look good for the wrong reason. The strategy may not be safer. The price may be slower. Andrew Lowe made a related warning about Sharpe ratios in hedge funds. When monthly returns are serially correlated, the measured risk can be too low. Serial correlation means this month's return is linked to last month's return. In plain terms, the marks move slowly. Slow marks can make a risky ride look smooth. The same warning applies here. If stale prices smooth the bad months, downside deviation shrinks. The numerator may stay high. The ratio rises. The investor relaxes. Then the real exit price arrives. This is the same old danger in a new suit. A ratio can only measure the data it receives. If the data is smoothed, delayed, or incomplete, the ratio smiles. The risk waits. The fourth wall is tail risk. Some strategies collect small gains for a long time. Then, one loss gives them back. Before the loss, Sortino may look wonderful. After the loss, the score changes too late. That is why the ratio should not travel alone. Show Sortino with Sharpe. Show maximum drawdown. Show the worst month. Show liquidity terms. Show how returns are priced. Show how many observations fell below the target. Use Sortino as a lens. Do not use it as a verdict. Now here is the practical trade. Before you calculate anything, choose the MR. Write it down. Use the same target across every fund in the comparison. If the target is cash, say cash. If the target is 5%, say 5%. If the target is spending plus inflation, say that. Then ask 3 questions. First, did the portfolio beat the target? Second, how large were the misses below the target? Third, does the history contain enough bad periods to trust the denominator? Add a 4th question. What would break the target next time? Not what broke it in the sample. What could break it in the future? For an option income fund, the answer may be a volatility spike. For private credit, it may be defaults plus stale marks catching up. For a retirement portfolio, it may be a bear market early in withdrawal. For a trend strategy, it may be a choppy market with repeated small losses. Sortino does not model these worlds for you. It tells you where to look. If the answer to the 3rd question is no, be careful. A high Sortino with almost no downside observations may be a warning label. It may mean the strategy is truly stable. It may also mean the sample is too short, or the marks are too smooth, or the tail has not arrived. This is why Sortino fits goal-based investing. It starts with the investor's line. It says, risk is not an abstract cloud. Risk is failing the job the money was hired to do. This is also why the ratio belongs in conversation, not in isolation. Put the investor's goal on the board first, then show returns relative to that goal. Then show the Sortino ratio. Only then compare managers. If you start with the ratio, you can be fooled by the number. If you start with the goal, the number becomes a tool. For a retiree, the line may be the withdrawal need. For a foundation, the line may be spending plus inflation. For an allocator, the line may be cash plus a hurdle. For a trader, the line may be 0, because capital loss is the pain point. The formula does not choose the line for you. It forces you to name it. That is its quiet power. Sharpe asks whether the ride was bumpy. Sortino asks whether the bumps went below the road. Neither question is enough by itself. Together, they tell a better story. The historical impact is not as loud as Black Skulls. It did not build an options exchange. It did not rewrite asset pricing, but it changed the language of performance measurement. It helped allocators talk about downside deviation, target shortfall, and return per unit of bad volatility. That matters because investing is not only about maximizing return. It is about meeting promises. Some promises are monthly. Some are annual. Some are written into pension plans. Some are private promises to a future self. Sortino puts that promise into the denominator. So the takeaway is simple. The Sortino ratio says return should be judged against downside risk, not total wiggle. It helped investors stop treating a surprise gain like a surprise loss. Before you trust a high Sortino, check the target, the sample, and the hidden tail.